Welcome to the Finance Podcast. The topic of this episode, Storms Bring Opportunities, Normality Brings Performance, with Gregor Trachsel and Sven Sommer from SG Value Partners AG.
Sind wir live? Gut, hallo und herzlich willkommen. Mein Name ist Adrian Gmür von der SG Value Partners hier in Zürich. Sie haben Glück, heute habe ich auch das S und das G mitgebracht aus unserem Firmennamen. Zu meiner Rechten ist Sven Sommer, der CEO der Firma, und zu meiner Linken Gregor Trachsel, der CIO von SG Value Partners. Vielleicht, bevor wir uns auf die Diskussion begeben, gibt es jemanden, der kein Deutsch versteht? Okay, all right. So we switch to English. That's obviously no problem at all. Maybe some of you know us already. You know, we're a deep value equity investment boutique based in Remistrasse in Zurich. We've been doing this for 20 years, quite successfully. And so we're very proud to be here today. And to instead of doing another PowerPoint presentation, we thought we'd do a little bit more of like an interactive conversation. So I've prepared a few questions that I'm going to ask mainly to Gregor. Maybe Sven will have a few things to add. And then obviously later we would also like to take your questions and have an interactive conversation. My first question goes to Gregor, and one of the things I've been really wondering is, were you born as a value investor? Were you one of these guys who bought shares in kindergarten and the rest is history?
No. I wish I could tell you that, but no. I had no clue what I was going to do in my life. Before I started my apprenticeship at Bank Vontobel in Zurich, so I had no interest in finance really. So I was not one of those guys that boast about having bought their first stock with 5 years of age. But we soon got to know the ropes when you enter this business. When I was an apprentice at Vontobel, we would play around and started in the business and buying and selling calls and puts, which obviously most of them were worthless at the end of their maturity. So that was something to think about. And then I got really lucky because when the crash happened in 1987, that was just after my apprenticeship. I was in military service, so I didn't have any exposure to the markets. But of course, I heard what happened, how much wealth was destroyed by people who sold after it went down. So that was a big mark in my career. And then, the common theme was really not to lose money, like Ben Graham did in the 1930s. So my logical conclusion was, I want to invest like Ben Graham.
Nice.
Probably I could say some words about me, because I was either not a value investor when I was young. I was more interested in trading, buy and sell, and short profits. That's what my goal. And in 2000, the dot-com market was there, and I was still in banking. And from my point of view, after that, I know that fundamentals are the trigger for investment and not the short-term situation or the short-term story.
Great. Okay, so let's dive into the topic of the presentation. I mean, we're talking about, I think the title of the presentation is, Storms Bring the Opportunities and Normalcy Brings the Performance. And so when we talk about storms and normalcy, like, what do you mean? Maybe Gregor.
Well, I think we're in one right now. Today is Liberation Day, as we all know. I don't know what it really means, but storms are always. We all know the examples, what's happening. They seem to occur with increasing frequency. I don't know if that's really true or whether that's always in the moment that you think now it's really bad, but I think it certainly, the world is not getting boring anytime soon, and I think how we go through these ups and downs is really to have a structure, how we want to do things. And Munger, from the partner of Warren Buffett, he always talked about the mental model. So everything we look at, every crisis that comes around, every company that goes down that's of interest to us, you're going to have the same film in your brain about how you want to look at the company. Do you think there might be value? And if you don't like something, you put it away again. You look something else. But the structure and the overall makeup of the portfolio, and we'll go into that a little bit, over time stays very much the same. So we cannot react to individual crises. We must act. We must know what the game plan is for individual companies, and then we'll go through. So our holding period for individual companies, on average, is between 5 and 10 years.
I would say it's 4.5 years over the last 20 years, but that's quite a good
because
range.
You're the trader.
Between, yeah, sure. That's still a little bit trading guys in me.
And so, I mean, with these there's tweet bombs every day from the White House, so we still sleep calm?
Absolutely. I would say it's important that you have a clear framework, that you work in this framework, and then you could go through. Even more, you could say that storms like that, or we have always storms, you could profit from that.
Yes, I think if you look at the current situation, you know, what's driving people to do things, I mean, as I said, you cannot react. So to give you a little flavor of the portfolio, really the portfolio is driven by 3/4, more or less, by cyclical companies. So we invest a lot in machinery, engineering, capital goods, materials companies. And, you know, they seem to be always under pressure. You know, the prices of those stocks, they signal you, you know, 6 of the last 2 recessions probably. They always react strongly to the downside. That gives us a hunting ground to look for cheap companies. So it takes a little bit of a pain threshold to hold cyclical companies. And then we have some stability as well in the portfolio. We have utilities, you know, being, you know, electricity, water, gas, heating, you name it. And what also goes in sort of the stability aspect is telecommunications firms. People hate them these days. The Vodafones and Telefonicas and Telecom Italias of the world. But they're stable businesses that everybody needs. And then there's a hodgepodge of different firms in agriculture, in media, for example, in real estate. So you can see it's all the proverbial old economy. That's our home, and that's how we define our circle of competence. We cannot analyze high-tech, fast-changing, you know, finance companies, healthcare, biotech, pharmaceuticals. We don't have the know-how to invest in those types of businesses, but we have the know-how to invest, you know, sorry to be boring, glass companies, steel businesses, cement companies, people who build the infrastructure of the world. That's how I think, you know, we can sleep at night, because we know these businesses have been around for decades and decades, and they will be around in the future. Otherwise, I could not sleep. And the other areas of the market, as you know, there's so many people, they're capable people of the world, But why do we have to dive into high tech as so many other smart people do? What we do is really go there where people think it's too boring, it's too cyclical, nobody likes it. You know, what should I do there? You know, we go where nobody else dares to go. And these are old, perfectly well-situated companies that you can analyze over the cycle how they do. And that gives us the stability. And when you find their situations for 60 cents on the dollar, then, you know, that's our hunting grounds.
Maybe Sven,
in general, our investment companies are in the middle of the value chain. And if a company is in a quite dynamic environment, that's nothing for us, because we don't buy the stories, we like to buy real things. That's, I think, it's for all of our companies the game.
And what do you think, what kind of character does it take to implement a strategy like that? I mean, what are useful traits to implement a strategy like that, and what is maybe not so helpful in running a strategy like that?
You have to be quite settled. You have to be disciplined. You have to be a little bit boring as well, but you have to be interested as well. I think that's very important. And if you always look just for the next story, that's not the moment as an investor as we are.
What maybe from your point of view, I mean, what are the challenges for implementing such a strategy?
Yeah, I mean, you certainly, I mean, it's probably not, if you're manic depressive, you're probably not the best person to do it. Warren Buffett says you have to exhibit a certain emotional balance. That's probably, so if you're a high octane person, then, you know, you should probably go to high tech and some of the other fields, you know, biotechnology, high finance and things like that. But what you do in our case, you know, as Sven said, you got to be pretty settled. Kind of boring, yes. But you have to have this emotional balance. That helps a lot. That's how it
and I think as well, you have to go through the world with open eyes. You have to be interested in how things go, how things were, and how it works, the economy.
Understood. Now, you mentioned a few things that look interesting to you, but in general, can you generalize a little bit more? Where do we see the big opportunities right now?
We're huge in materials. Materials, they're under pressure from all sides. Let's take cellulose and paper companies, for example. Cellulose, you need in practically all applications that we have to deal with on a daily basis. And they're under pressure. You know, clients are destocking from the run-up in their purchases following or during the pandemic, for example. And then the war in Ukraine happens. So you have exploding energy prices, cellulose, paper manufacturing, cardboard manufacturing is highly energy intensive. So that hurt them. And now you have the tariff wars, increasing globalization problems that, you know, is not going to help the business. Plus, the Chinese economy, as you know, they have moved away from infrastructure investment. What do? They go more into the materials that they want to sell to the world. So they're producing glass, they're producing paper, they're producing steel, as we all know. So they're swamping the world market with cheap product, and this is all coming together for the poor paper companies that have relatively, you know, modest margins to begin with. But I think everything has a price, and if you're a market leader that you know, can achieve some cost leadership, and all the weak players are going away, and you can play the consolidation game. That's really the type of things we're looking for. And other materials companies, they're in the same boat. Whether you're a steel company or a producer of glass bottles. Glass bottles is another thing. We own two of the large global players, Verallia and Owens, Illinois. Not interestingly, also household names today. Not everybody, considers them the Apples or the IBMs of the world, and they have tremendous problems. The beer and wine consumption is going down. Is a secular downtrend. Energy costs, which are huge for the business, obviously has exploded. And then Trump comes along and says he's going to levy 200% import tariffs on French, champagne and wine and so forth. So it's a perfect storm for these companies, but that's why they're cheap, and that's where we go in. So it's a little painful to do it because everybody else don't want to touch these firms. But if we think that the balance sheets are strong enough to pull them through not only cyclical problems, but also they can handle the structural issues of the business, then I think those are the few players that will survive. So you can be a big player that makes money over time, even in a mature industry. You might even argue it's a sunset industry, but you can make money in those businesses. And that's where we focus on.
And important is that you could buy these stocks quite cheap.
Yeah.
On the other hand, we are problem managers. And if a problem is not permanent, we could take advantage of these problems in the short to midterm and to let it grow in the portfolio.
Now, these examples were very specific, but Sven, can you maybe talk a little bit from a geographic point of view, or is there any particular places where we find opportunities
Not at all.
right now?
Problems are globally.
Global.
And I think they are globally as well in the next few years, as we see now. We are real global investors. That means we are not just in Western Europe and North America. At the end of the day, it's always the single investment. That's the trigger and the price that we pay off. If you look to our portfolio, it's really globally as well. We invest in emerging markets. Over time, I would say the quote in emerging markets is between 10 and 20%, but it's not top-down, it's just bottom-up.
So where do we have exposure in emerging markets right now?
Right now, it's mainly Brazil. And it's always a little bit the question, what's emerging markets? It depends a little bit. The emerging markets today are probably tomorrow not emerging markets. I would say Turkey a little bit, and in Asia, some markets are quite interesting.
Yeah. Now, we're a Swiss company based in Zurich. This is a Swiss conference here. Do we have any investments in Switzerland, or how does it look like here in the local market?
We recently established a position in Stadler Rail, which is known to everybody in Switzerland and everybody who takes a train or rides a tram. It's been a perfect storm for them as well. They were listed on the stock exchange and everything went well a few years back, full order books, and now the business is slightly consolidating. And then they have the big problems with the environmental issues, with floods, mainly last year, one in Spain and one in Austria.
And one in Switzerland.
And one in Switzerland that hurt them big. So these are the type of situations, stable companies that are admired, that will not go out of business. They have a strong order book still, and they're walking through a cyclical adjustment. And people went in the IPO, and then they got slightly disappointed. And now we are the next guys who are taking a look at it. We're not interested at the IPO price, and now we start to get interested. And, for example, and that is now a word about portfolio management. First of all, we're pretty much equal weight portfolio structures, because again, we want to sleep at night, we want to diversify opportunity as well as risk. So it's also diversifying the opportunities. But if Stadler Rail goes down in price, we buy more of it. If the case doesn't change, we buy more of it. We cheapen the average entry price, and that's over time how we make money. So we use the cyclical downturns to our advantage in that we buy.
So quite literally here, the storm again and the normalization. Yeah?
Exactly.
Yeah.
And then we own Valiant Bank, for example. This is an archetype of a stable business. A Swiss regional, plain vanilla bank, very solid, very conservative. They grow nicely, but they never lean themselves out of the window. They know what they do. They pay a nice dividend yield. And this is one of the components that makes the portfolio stable. Investments like Valiant Bank that really bring in a certain balanced structure to the portfolio, to our big exposure to the cyclical parts. So it's really a barbell strategy where we have the huge ups and downs in industry and materials and capital goods, balanced with types of Valiant who are really, they're running like a clock and pay a nice dividend.
And we owned a lot of Swiss stocks in the past, but they all realized, because in Switzerland there are quite nice companies, but right now there are not so many cheap ones. They are quite good priced at this time.
Yeah.
We used to own ABB. We just recently sold it. It reached a full price. We owned them since it was 1 franc or so.
1 franc 24, my dear.
We sold it at 50.
It's a long time ago.
It took a few years.
A few years, yes.
Compounding is nice. It's certainly not every investment that works out this way. We still own some Holcim, but it's now appearing fully valued. So we're in the process of selling Holcim. So we have large, well-known firms as well, but a lot of them have worked out tremendously, and that's one of the examples. You know, Holcim, highly cyclical company, but it has worked out even though they're facing headwinds. So it's always a matter of at what price you buy. It's not the story we buy, it's the valuation we do, and that's the core of our business. But again, it's painful, and that's why there is no free lunch.
Generally, it takes time to figure out, and the volatility is quite high because we own a lot of small and mid caps as well, and the emerging market as well, and that costs. That is why there is no free lunch.
Excellent. Now, maybe time to see if there's any questions from the audience. Anyone wants to ask a question to this? Yeah?
I just want to ask, I hear that you concentrate mostly on the boring stories, and we have seen even Warren Buffett some few years back investing BYD, experimenting, let me say that. Don't you think you're leaving some success stories on the table by not experimenting with the stories?
Absolutely, absolutely. We leave stories undiscovered and undetected. We know that, but it's up to our end client to decide how they want to diversify. We are clear in saying what we do, and we are more into the boring types of the market. if people want to have high excitement ideas and have this huge upside in a stock because it's an exciting new technology, an exciting new market that they want to cover, it's up to them. We have to stick with what we know. But don't make mistake, as Sven said, it's a very creative job, but the creativity comes into, in our case, not through venture capital and investing in new exciting types of things, but we are going to use creativity to see where there is value or most people don't see it. For example, the European telecoms company is one example. We have been waiting, sitting in there and waiting for ages, and now they're making moves, you know. The Vodafones and the Telefonicas, Telecom Italias, you hear what's happening at the moment. Telefonica as well as Telecom Italia, they are now declared officially national champions by the respective governments, Italy and Spain, and the anti-competitive regulations that's superimposed by the EU to strangulate really the profitability of those businesses is getting more and more cut back. If, you know, Mario Draghi and people like that come out with saying, you know, guys, we have to do something, otherwise we're going to be the European Museum and not something where companies can make money. So competition will be allowed to increase in that business. And for that, you have to... You're in an exciting story as well. It's just a different type of exciting story that most people are thinking about.
And the other thing I can tell you is I've been sitting with these gentlemen now for more than 2 years. I think it's really about the discipline. So the discipline on the way in and the discipline on the way out. And we've had a few stocks that became story stocks later, right? After so we bought them for a very cheap price. And then we were disciplined in selling, and then they became story stocks. Like any example comes
probably
to mind?
Rolls-Royce.
Okay.
We bought it in 2020. Rolls-Royce is the producer of big engines for the jets, and the people think after the first corona wave, nobody's flying again, even not long term. And we sit together and say, probably people would traveling again and would flying long term as well. And then we bought, I don't know, for a hand of pounds or pennies. And now it's a story because it's a growing market as well for the jets and as well for the weapons. That's probably one of that. It was a horrible company, and after it was a grateful story.
And it changes from yesterday to today. You know, the defense sector. Everybody is running now into defense. We had some defense stocks, not on purpose, because we didn't know that J.D. Vance would have his speech saying, you know, Europeans, you know, take care of yourselves. We didn't know that in advance, but we still owned Leonardo. We owned ThyssenKrupp. We owned, in Japan, very prominently, Mitsubishi Heavy Industries. Mitsubishi Heavy Industries, we owned them for years and years and years. The stock never did anything. And then, all of a sudden, you know, the change of mind by the Japanese that they have to take care of their defense on their own and not being able to rely on the Americans forever, the stock went like this. So we have many examples
do nothing
like that.
For a decade or even more, and then the last 12 months it was like a rocket.
But that's what we mean by acting and not reacting. We are bad in reacting to new things and trends, because when they come, they already happen. You know, we had an entry price at ThyssenKrupp at €3, and now it went in a few days. It went to 10 or something. We didn't know that. You have to sit in there. If you react, you're starting to pay enormous money that you leave part of the story already you leave it at the table. So that's what we do. But it's costing nerves.
And that's why we diversified the global portfolio between, let's say, 60 to 100 position, and equal weighted in an aggregate. That's why that, because sometimes it takes years, sometimes it takes months. We doesn't know. We don't buy the momentum. We buy the fundamentals.
Got it. Yeah?
How do you compare the portfolio's performance relative to relevant indices? I don't know what it can relate to.
I'm not the man for relative performance.
That's Adrian. You're the man for relative. You know the competitors as best.
Thank you.
Sure.
It's very good to pass me the hot potato here. So in general, we are absolute return investors. So we really don't try not to consider the benchmark. If you look at the makeup of our portfolio, it's very different from the global benchmarks. Our biggest 3 country allocations right now are Japan, Italy, UK. No US, I don't know, is number 5, 6 down the line. So we don't necessarily want to compare to a benchmark. I mean, we have now 20 years of data where we see how the strategy works through good times and bad times for value investing. And we are quite satisfied with the result, with the absolute returns. But we know there's going to be periods of time, unfortunately it's been long periods of time, where, strategy doesn't look so appealing, but we just keep at it and keep compounding. And yeah, we have to accept that our strategy will not always work, but the data that we have, other value investors have over long periods of time, that give us great comfort and confidence that we can generate, and our goal is to help the saver compound their capital. That's really the goal. And so if we can achieve that with high single-digit type of nice returns over 20 years, that's a nice sort of compounding. That's what we're aiming for.
Yeah, I mean, we're looking to the company.
Well done,
what's the yield on a company? A company of modest, let's say, growth and modest margins, the types of companies that we have, if they generate returns on equity over time of, let's say, double digit, I'm not saying, at least 10% or so. That's sort of how a shooting target for us. If we can generate, 10% compound, in Swiss francs over time, it's been a little
bit
more
less
difficult. As you all know, you're always running, especially as a global investor, you're running against the strength of the Swiss franc. But
in euro, it's around 10% over 20 years. That's our goal, to get in this range. And on the other hand, it's important to realize our portfolio, it's a real diversification to anything else you had in your portfolio. And I think that's an advantage as well. If you get a portfolio with an active share of 90% plus.
Yes, please.
Why Italy? Can you talk us through some of the factors that are driving your conviction in the country?
Well, we have certain what we call pockets of value. And Italian companies, they tick a lot of those boxes. For example, family-owned companies. We own some of the conglomerates that are controlled by families. We like that because they plan for the next 20, 30, 40 years. We like that. We like that. We don't like strategy changes, from one quarter to the next. And so that's one thing. And the other thing is certainly they're doing a lot in industrials. They have magnificent industrial companies, automotive parts manufacturers. Leonardo, I mentioned, as a defense contractor. And they also have nice media companies. We own some Mondadori, for example. They're a book publisher and run bookstores and stuff like that. It's really an old business. But these companies, I think, they excel through their their brand name, their customer loyalty, and again, their long-term thinking. Plus, what I didn't mention, what's a huge factor in the portfolio, I love conglomerates. And most of those family-run businesses in Italy, they're conglomerates. You know, they have an industrial part, maybe they have a financial part, they have a real estate part, and they have a media part. That's sort of the stereotypical one. And we are attracted to those, mixed types of businesses because they give us an added diversification. Within one company, you have, companies, divisions that run very well at the moment, and other ones that have a really tough time. At another time, it's going to change around. That again gives stability to the portfolio. So that's one of the characteristics, I think, with Italian firms.
And the other thing Gregor didn't mention is, in 2011, 2012, you could buy them at giveaway prices, right? I mean, this Euro crisis was really the trigger.
That was really the entry.
That was the entry point, 2011, before we owned
almost.
XOR ones after the financial crisis. Otherwise, we had no positions in Italy.
Yeah, we started really to look in Italy at the European debt crisis with the Northern European utilities, the Northern Italian utilities, the Heros and the Irins, because people thought they would not be able to carry the debt on their balance sheet, which of course, at the end of the day, you can argue a utility is safer than government debt. And so we took that risk. You're taking a risk. If a heating or electricity utility is going bankrupt, I think that you're going to have completely different problems again. So I think we were convinced that they're not going to go there. And so that was a starting point where we did more and more in Italy.
Maybe time for one more question.
Quick question. You mentioned something really important for investors, that is like the emotional resilience. And I would like to ask you, what do you think about the short future? So what I was
The short future? I have no clue.
Like on 1999, everybody was blaming Warren Buffett because, like, apparently he was not performing well. There was like the internet coming on. Everybody was like rushing.
Like now, KI.
Companies, and he's, as you said, he stayed like true to his valuations. And after just 2 years, the dot-com bubble like came up, everything crashed, and he was proved that he was right. Do you see some parallelism with that? And right now, like AI, Bitcoin, everybody's like on a high.
First of all, I'm too stupid to analyze that. I have no clue. But it is so important to realize you have to be in your scorecard and do what you understand. And the second one, I'm quite sure, over time, not short, not mid, but over time, the world is normal. That's absolutely, you had this dot-com bubble, now you have the KI, the next time it's another thing, but over time, the world is normal, I'm quite sure.
Do you feel that maybe we will have like a bubble soon, that will...
A bubble, you know, if it's a bubble, you know after. You don't know before. But I think it's right now a lot of people who invest in the market, they are driven by ideas or by psychology, not by fundamentals. That could be a sign of a bubble, but I don't know. Okay. Sorry for that. I don't know if you had some other thought about that.
No, I think no. We don't care about how overvalued the whole market is, as long as we can find things that meet our criteria. We don't make a judgment about other things. This morning I was looking at GE, We were looking at GE to invest, but we didn't do it. I didn't see it. Now, this morning, I just looked at the quick ratios of GE. It's trading at 38 times earnings, and it's 12 times book, and it's 32 times EBITDA, enterprise value to EBITDA. So it's crazy valuation for us. Is it too expensive? We don't know. We just don't touch it. So what the rest of the market is doing, we're only saying we cannot look at this. We have to focus on what we do. And as long as we can find cheap steel companies that have a real legitimate future, and as you know, a steel company has a legitimate future. Otherwise, you wouldn't be declared also as national champions. You know what's going on with the Nippon Steel bid in the US and things like that. And the holy cow that, for example, ThyssenKrupp still is for Germany, even though felt, steel is not important anymore. Well, when you look at Germany, steel is still important. So we focus on things like that, where a lot of people don't want to do it. We have such a broad field where we can dive into, and I don't like to sit at night at CNBC and, bite my nails.
Show me your nails.
Say,
Show me.
Whether I have to sell everything still tonight, or if I can sell them tomorrow, or whatever. It's not in my DNA to do this.
I would say long term there would be always problems. That means what we do works over time, but it hurts probably short term. I would say that's for the mid to long term to say about that.
Do we have more questions? Otherwise, we probably have to wrap up. Sven, maybe just quickly, what are the 3 major things you want people to take away from this conversation we had here?
It hurts, it works, it takes time.
Brilliant. Thank you very much. Thank you all for attending. And
thank you very much.
Come visit us at the booth. We're here the next 2 days. Visit our website. There's lots of materials there. Love to help you with your saving goals.
Thanks for being here.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.